Welcome to this week's live ASX strategy session. Thanks for joining me. Great having you with me for this special holiday edition, the New Year's Eve edition of the strategy session. I'm coming to you today because there's a few interesting things to go through in the market. So I wanted to touch base, go through a few things, especially in the commodity market, some interesting things going on there. So we'll get to that a little bit later, of course, with the Aussie market and the US markets in there to start with. Now, everything today, general commentary only, doesn't take your personal situation into account. Having been through all of that, let's get into this week's first chart. And starting off with the ASX 200. And well, this has been a bit of a seesawing battle in the ASX 200. As we've been discussing in recent weeks, the ASX 200, it's been in that classic vulnerable position below declining moving averages. You can see the moving averages started to turn down in mid-November and crossed to the downside in December. And we've had this consolidation beneath there since. So if a market is going to sell off, this is where it would often happen from. It's where the structure can change from. It's where the structure changes from prices rising above these rising moving averages to where it flips to prices potentially trending below declining moving averages. So that, of course, that hasn't happened yet, but that's the setup which you get below these moving averages. But so far, that vulnerability hasn't resulted in a repeat of the selling that we saw during late October, early November. There was an attempt to sell the rally back to the moving averages a couple of weeks ago, but prices came off. There was no follow-through selling, and now we have a situation where prices are back above those moving averages. I think the latest rally, this rally we've had just in the last couple of weeks, I think that diffuses the immediate. I think it diffuses the immediate vulnerability that was present when prices were below the moving averages just a few weeks ago. And so when we look at this now, I also like that there are early signs of a series of lows developing. You can see we've got like a couple. It's only early signs, but there are a couple of lows in this structure since late November. And I think the key now is for prices to become established above the moving averages, and then for those moving averages to in fact turn higher. So despite the vulnerable price structure over the last few weeks, we've been discussing a bias towards the upside. And that's been due to what we've been seeing in the equal weight index. So just quickly jumping over to the equal weight and seeing what that's been doing the last week or so. So while the ASX 200 has been consolidating below its moving averages, the equal weight has generally been holding the line above the moving averages, and those moving averages still generally continue to move upwards. And the price action we've seen through December, so you can see this price action where we've had this shallow pullback towards the moving averages. When you get those shallow pullbacks, it's often a sign of buying interest, in buying the dip. And you might remember we also talked about this little flagging structure a couple of weeks ago, which prices have just broken out from. Actually, there's a really good example of this in the small ordinaries, which I'll show you in a few minutes. So we've had a rally, the consolidation, then a breakout from there. So that's all. I think that's all positive sort of price action and price structure in the equal weight. And this isn't the sort of structure that you get if a market is on the cusp of selling off. The reason I think it's important to look at the equal weight is because it removes a potential distortion that you get when you just look at the ASX 200. And that distortion can be caused by what's happening in a few big stocks. So CBA has been a big influence on the ASX 200, as it always is, because it's the largest stock currently. And when you look at the equal weight, it just removes the influence that one stock might have. I think the equal weight often provides a better view of what's going on in the broader market. And at this point, I'm looking at this price action as being an ongoing consolidation after a strong bullish phase off this April low. So strong rallies lead to consolidations. I think that's what the odds favour we're seeing at the moment. And the price action suggests that the dip is being supported. So I think this remains an overall upward trending market. I remain long stocks. I remain long ASX stocks, and I'm continuing to look for opportunities. I bought a stock today. For instance, I'm still looking for those opportunities in the market. And as always, I've got my motion trader trailing stops. And I think that's really important because like we never know. I can say I think the odds favour an ongoing upward trend, but at some point that trend does turn. And so that's what the trailing stops are all about. It's about protecting capital when the situation does invariably change. Certainly scope for more consolidation in the near term, but at this point, I think it remains a bullish structure. Okay, we're going to jump to the US market next, and then we've got the local small caps, the US small caps, the commodities. If you're getting some value from this, click that like button. Helps me a lot when you do that because then YouTube shows other people because YouTube then goes, well, okay, people are watching and they're getting something from it. So doing that, sending that signal to YouTube helps me a lot. So please do that now while you're thinking about it and leave a comment. What do you think? Are we going to see a January rally in stocks or is something else going to happen? Your comments and your thoughts are always interesting in that comment section below. All right, so let's jump over to the S&P 500. Well, the S&P 500 looks set to close out the year just a fraction below its all-time high from a couple of days ago, from Friday. And I believe that was, by my calculation, the 40th all-time high for the year. So the 40th all-time high for 2025. So that makes 2025 the fourth best year for record highs in the last decade. So it has been a particularly strong period. And stands in contrast to how the year really got started. Like it just goes to show it's don't fall for the trap of looking what's happened in the past couple of months, particularly when we get some of these scary sell-offs, and assume that it's going to be an ongoing bust because things as we can see do change. While we saw an all-time high on Friday, prices have generally been trading sideways for a couple of months. You can really just see this here. The last couple of months, prices have been moving sideways along the moving averages. There hasn't been a whole lot of movement overall. And I think that's okay. I think the latest price action helps to consolidate the strong gains we've seen since that April low. So like we pointed out in the ASX 200, strong gains, and now we've got this sideways consolidation playing out. And as it stands, we've got rising moving averages. Moving averages continue to rise, and prices has mostly been above those moving averages. So by definition, that is an upward trend. What makes this interesting is that much of the strength has come from outside the tech sector. Well, particularly in the last couple of months. And it's interesting to contrast the S&P 500 with the Nasdaq. So just jumping across to the Nasdaq, and you get a bit of a different picture. So while the S&P 500 has made a new all-time high just a couple of days ago, the Nasdaq hasn't made a new all-time high since over here in late October. So from that perspective, you could say there's negative divergence between the two big indices. So it's you've got the Nasdaq not making new highs, and we've got the S&P making a new high. It's actually you can see the contrast better if we look at the Dow. So look at the Dow, for instance, the Dow Jones. You can see it clearly making a run of new highs, whereas you come to the Nasdaq, and we don't have that. So that is what we'd call that bearish divergence. I think this is something just worth being aware of. It's worth being aware of because we really want the indices all confirming one another in an upward trend, and we do have this relative weakness in the Nasdaq. But I think the more important story at this point is participation, in that there are more stocks participating in the rally now than there were only a month or so ago. I'll show you what I mean in a moment. As it stands, the Nasdaq is it's consolidating above rising moving averages, and you can also see that classic compression. You can see that classic compression in the price action, how it's coiling up, and I think a breakout from this pattern, be it to the upside, or the downside, be aware, always be open to all sorts of possibilities. But I think a breakout one way or the other from this compression, um, I think that will set the tone for early 2026. If I were to pick a side, I think the odds favour the upside. But as always, nothing's certain. We always need to manage risk. Um, I mentioned participation a moment ago. I show you what I mean by that. Coming over to the equal weight, the S&P 500 equal weight, and the equal weight hit a new record high in mid-December. So that was a new all-time high for the equal weight. This indicates that there's a broad range of stocks that are participating, and it's not just a narrow rally led by a few big tech names. When you look at the S&P 500 on its own, it can be distorted by some of the bigger stocks doing well. But for the equal weight to be making new highs, you've got to have that broad participation, because every stock is, of course, ranked equally. I think there's scope for more consolidation below the all-time high. For instance, we could get this market could chop sideways, retest those moving averages before maybe breaking high. It could be somewhere into mid to late January. You never know the timing, but I think the point is there's scope for more consolidation before potentially moving higher. But the overall technical structure, I think it remains positive, and this remains a bullish trend until we get a situation where price is below moving averages and the moving averages are turning and price is breaking lower. That, I think, would take a bit of time to set up. It's not the situation we currently have. There's one more thing I want to point out with the US market, which I think is particularly interesting. It's the US government bond 2-year yield. And let me just compress this a bit. So we had a big rise in yields into 22, into 23, when we had inflation was running hot, rates were rising. Rates have then gone through quite a steady period during 23 into 24. And then what's been happening in the US, which is different to what's been happening in Australia, is that there's still downward pressure on interest rates. And when I look at this chart, like you can see there seems to be you could say there's support that comes in around that 3.5% mark. And just looking at this chart, it looked to be on the verge of breaking lower. There could be a significant breakdown in yields, so lower interest rates in the US, and these have been treading water, just particularly in this last little bit here, maybe the last 4 months have really just been treading water and moving sideways below these declining moving averages. So the path of least resistance remains in a downtrend in yield. But this compression they're in, this consolidation they're in, if this breaks to the downside, we could get quite a decent move lower in yields in this 2-year bond. So what that means for markets, well, it could be argued that lower rates point to a weaker economy, so maybe that's bad for stocks. But I think it could also be due to Trump's pending announcement of who the new head of the Federal Reserve is going to be next year, and it's tipped that it's going to be someone who's going to be sympathetic to lower interest rates. And could the prospect of lower interest rates fuel a stock market rally? I think that's entirely possible. So this is just something to watch for now. And we need to see how stocks react should we get a break to the downside. But I think a fall in the 2-year bond yield, it could have implications across the markets generally. So something to be aware of, something to watch. Okay, so let's jump over to the small caps now. We'll start with the US small caps, Aussie small caps, commodities, really interesting stuff happening in silver in particular. And but of course, that wraps up the free section, and also going through your stocks. Any stock codes you've got, get them ready. We'll go through them as well. But as I say, that wraps up the free section. If you're not a strategy session member, link below, click that, come in. Doesn't cost you very much. We're going to go through a whole lot more interesting things which could maybe help you quite a bit. So think about doing that. All right, so let's start. Let's start with our US small caps. We'll start with the Russell 2000.